So interest rates determine the bond price. So this discussion is going to be very interesting. So if a company issue a bond, for example, this is the certificate. On that certificate, there's going to be a face value. For example, face value is 1,000. There's going to be maturity value. For example, it's 5 year, right? And there's going to be the interest rate that the company would pay, right? And also the term of payment, semi-annually or yearly. Let's assume that it is at the end of the year, yearly, right? And also there's going to be interest rate that is in the market, right? We also call this bank rate, market rate, or yield to maturity. It's pure finance term, okay? If you don't understand this, then just don't worry about that. Just consider it as a market rate, right? Okay, for example, in the market it is 12%. So recall your discussion in our economics class, that is demand and supply. So price is high when demand is high, price is low when supply is high, right? Think about that. The bank asks from you to deposit the money with it and it gives you 12%. And the company asks you to give money as a loan and company going to give you 10%, right? So the rate that is written on the face of the bond, we call that stated rate or coupon, right? So it's your choice. You want to deposit with 10% or you want to deposit with 12%. So what is the logic here? Of course you will go to save your money with the bank at 12%. So what will be the value of this bond? Because they cannot increase the interest rate because it's already printed. Plus it's for 5 years. Who knows? After 1 year the interest is going to be decrease or increase, right? What happened at the at the end of 5 year? Maybe the market rate, because this changes on yearly basis, and the management of this company, they issued the bond for 5 years. So they also calculated and talk about that. Okay, for 5 years we maintain this payment for 10%, right? But market rate is it's subject to market conditions. In 1 year it is 12%, and maybe next year it's 13%, maybe in third year it's going to be 9%, and maybe after 5 years it is 7%, right? Who knows? No one, right? So now we have opportunity here either to invest our bond at 10% or either at 12%. Of course people will save their money to the bank at 12%. This forces the value of the bond lesser than the face value, and we call that bond is issued at discount, right? So that is very nicely written here, that the market interest rate, the value of the bond is also demanded by investors. And the other stuff, premium. So this is the case of discount, right? I hope you understand. Discount means that the company coupon rate is lower and market rate is higher, right? Coupon is lesser than market rate, right? Like here is 10% is less than 12%. So bond will be issued at discount. Let's talk about the premium case. Here we go. Let me just remove it. Be patient. Okay. Now what happened? Company is, after some time, passed, and company is giving you 10%, right? This 10%, and markets now is interest rate is 8%. What is your evaluation here? You will take your money out and you save it with company. In other sense, you buy the bonds of the company. And why is that? Because you want to earn money and you want to earn higher rate. So market is giving you 8% and this company coupon is giving you 10%. What do you think? Only you are smart enough to figure this out? So the whole market now want to invest money with the bank at 10% because it gives you hard money. So that increase the price of the bond. So for example, people will say, don't worry about that, I'm going to pay you 1100 for this one because I want to earn this 10%. If I put my money here, I will get 8%, but if I buy this bond, I'm going to give 10%. So this pushes the price bond value, which is, if you understand the time value of money, we also call this present value. If you don't understand that, then just don't worry about that. Just think about it, that if there's going to be huge demand for this one, then people want to pay higher to get this one in order to earn more money, right? So we call that this is issued, or this if already trading, this bond is trading at premium, right? And what is the condition for premium? If market rate is what? Is less than, right? If market rate is less than the coupon, or if coupon rate is greater than the market rate, we call that the bond is trading at premium. And it's very simple logic as well, right? If company is giving you higher rate, every person want to purchase that company's bond. So demand for company's bond will be higher. When demand is higher, price of the bond will be higher, right? If market is giving you higher interest rate than the company, then the people, they are not interested to buy the company's bond, and in that case the market value of the bond start decreasing, and we call that discount. Okay, so here we go. So this is very nicely explained here. So assume the stated rate. What do we mean by stated rate? It is coupon rate, right? So if coupon is 8%, which means company is giving you higher rate and market rate is 6%, market is giving you low, then bond will be sold at premium, right? If company rate and market rate is the same 8%, then it is traded at par, which means here the value will be greater than 1000, here the value will be exact 1000, and if company is giving you 8% and market is giving you 10%, then the price of the bonds start decreasing, and people will invest more in market, so it will be traded at discount, which means value will be less than par or less than 1000. Okay, let's talk about the example here. So I just want you to pause the video and try to understand this example, then we solve it together. Okay, suppose Southwest Airlines has $50,000 of 9% bond payable that matures in 5 years. So remember, this 9% bond payable that mature in 5 years, this is called coupon. That is, means it is written on the face of the bond. So assume that Southwest issued these bonds at par, which means this 9% coupon is exactly equal to the market value. or sorry, market rate. In the market is also 9%, right? So bond will be issued at par. It means the total value of the bond is 50,000. That's it, right? So the entry when the bond is issued would be, right, you receive cash increase, and you create liability. So this liability is going to be long-term liability. And why is that? Because you will pay back this loan after 5 years. Bonds payable, right? So we just finished issuing the bond payable at par, right? What is the treatment for interest payments? So question mentioned that interest payments occur January 1st and July 1st. Means after 6 months, we call it semi-annually. It means 2 times in a year. So what will be the interest expense? How it will be calculated? 50,000 multiplied by 9%, that is 4,500, right? And we want to find it for 6 months. 6 months, so 6 by 12. Answer would be 2250, right? So when we pay this interest expense, then what will be the entry? If we pay by cash, if we paid it, right, it means we pay by cash. So interest going to be our expense, interest expense to cash, 250, 250, right? Let me just remove it to see whether we have done it correctly. Here we go, right? So we calculated it, 2250. Answer would be interest expense to cash, right?